Hello, everybody. This is Jake Stenziano, host of the Jake and Gino Podcast, here with my co-host, the multifamily mentor, the coach, the chef, the father of six, the best-selling author, the G-Daddy, Gino Barbaro. Gino, how's it going?
Jake, I'm doing good this morning, brother. How you doing?
Always making it happen, big man. Today's guest advises limited partners. We're talking LPs on investment strategies. Currently writing a weekly newsletter for over 3,000 investors on those LP investments. Previously, he managed Store Capital's $10 billion real estate portfolio and holds a quadruple. This is the first time I've ever heard this, by the way. A quadruple major. I heard of doubles. I didn't know. The triples must be out there. Quadruple. This is a first from the University of Arizona in finance, mathematics, economics, and accounting. So without further ado, Aleksey Chernobelskiy, welcome to the show.
Thanks so much for having me, guys.
Hey, it is our pleasure. And, I'd love to hear a little bit about, your beginnings into the real estate game and, your time spent managing Store Capital's portfolfolio.
Yeah, I started on other types of investment strategies. So I did some quant-related stuff, distressed debt, private equity, like turnaround work. And then when I moved to Phoenix, actually, I landed at Store. And that was a pretty fascinating experience. We had almost 3,000 properties in the US. I led the team that managed that whole portfolio, and also underwrote any new transactions, right? And so we were pretty active. Typically bought like somewhere between $1 billion to $2 billion a year.
You're over the asset managers, then, I'm guessing, yes?
Two sides. So I led the underwriting team, which would be any new transactions, like looking at risk reward, understanding the transaction, understanding whether it's worthwhile for the firm to do it. And if we actually bought the transaction, it would fall back on my court for the portfolio management function.
What would you say the typical deal you guys were hunting at that? Give us the characteristics, vintage, kind of the area that you're looking in. Kind of give us that
Sure.
that view.
So they were actually pretty diverse, but pretty similar. So the similarity was they were all freestanding commercial buildings with one tenant inside. So think a gym, a pizza store, a manufacturing facility, right? And so there is, if you just drive around the street in most areas, there's an endless amount of these buildings, right? Typically, they're occupied by a tenant. Typically, that tenant, or I should say, occupier, right, has some sort of SBA loan or mortgage on the property. And so what we did is sale leasebacks, which would allow the client to take out all their equity. It's almost like kind of like 100% loan in a sense, but you also transfer ownership to the landlord. And then you rent for like on a 15-year lease.
Aleksey, how did you get into real estate? First of all, why 4 majors? Like Jake and I, we only have 1 major each, so you're doubled up on us. We only have 2. You have a total of 4. Why real estate? What made you get involved and excited about getting into the real estate business?
Yeah, so I guess I'll start with the majors. To be candid, I just thought majors equals opportunity. And I came to the US when I was 11. And so I was under the impression that if you get more majors and a better GPA, you'll get better career opportunities. For anyone listening that might be in college or have kids in college, that is definitely not how America works. um, uh, so I kind of learned that the hard way, and I don't think I would get 4 majors, and I would not encourage my kids to do it. And then as far as real estate, look, I like investing. I think what's fascinating about real estate is that it's such a big industry with so many different um, asset classes, and there's a lot of opportunity, right? I think the further away you get from efficient markets, or I would say as close as possible to efficient markets, the more interesting things get, right? And in the real estate world, you'll just see things that are so wild sometimes, right? Because it's a pretty illiquid
I think
market.
you have to define an efficient market first before we can have this
Sure,
conversation.
sure. So, generally speaking, it's a market that prices in risk quickly, right? And so I think the best example of such a market would be the public markets, like stock market. But to be clear, I don't think that they are efficient, but I think it's as efficient as a market can get, right? Meaning if some news breaks within seconds, the stock market starts reacting, right? And the stock market obviously is determined by its participants and selling and buying. Whereas, you know, something could happen next door from my building, but you just have no idea how the value has changed until you decide to put it on the market, and maybe even then you have no idea because you didn't get any bids, right? So in that sense, the market is very opaque, right? And with that comes some benefits, including the fact that it's a very inefficient marketplace.
So what I'd like to focus on is the LP limited partners, because the limited partners had a beautiful run up the last several years, and now they've hit some bumpy roads, and now they're blaming all of these general partners and all these operators for, losing my money. What do you see the journey of the limited partner over the last several years, and where have they gone wrong, or how are these deals, I guess, turned bad for these limited partners over the last couple of years for these passive investors?
Sure. Um, Maybe the first place to start is, um, I think this is important to mention, is like where should the blame be, right? In other words, if a deal goes bad, is that limited partner's fault or the GP's fault? I genuinely believe that it's, in the vast majority of cases, it's a mixture of both. Um, I've seen many deals on the GP side that were marketed as, I mean, in some cases it says risk-free, in some cases the decks say guaranteed, in some cases the GPs were saying like, get the hell out of the stock market. It's gonna all like free fall, and you should put all your retirement with me. In some cases, LPs actually did that, right? And so I think there is certainly a pretty long conversation to be had about what's to be learned out of the past few years in terms of the GP's actions and the LP's actions. Um, in terms of what's going on now, obviously, as you said, a lot of deals, not a lot, but a decent chunk of the deals that at least were done in the past several years have had some level of distress. For what it's worth, I really believe that for every LP that realizes that their deal is underwater, there's probably 10 LPs that have no idea that their deal is underwater. Right? So that just comes down to like being aware of your investment and what's happening. And also, obviously, GP communication, which in bad times tends to be lagging, to put it nicely. Yeah, so I mean, there's a lot going on, and I'm happy to address or answer anything.
I think there's, you know, clearly the LPs don't have anything to do with the deal, right? So I think it comes down to a personal responsibility stance, right? The GP, if the deal fails and they said the deal is going to do well, that's on the GP, clearly. Where the personal responsibility comes in is, was the LP lazy with their money, not vetting the GP enough, and they trusted somebody without doing the needed research and education that comes with being an LP. I think the key here to understand is that it's your money as a limited partner, and you still need to educate yourself on that specific asset class, on the deal, be able to underwrite the deal. This is not just willy-nilly pick a stock, throw some money in, and hope. Like, if you really care about your money, there's a level of self-responsibility and care and professionalism that should also trail that money, to ensure that you're, as we like to say, Aleksey, we call it baby money soldiers, right? We don't want to kill our babies, right? We want our babies to multiply and grow. So you can't be putting them into a fruitless war, right? It's upside down, Gino. Okay. Hold up that greenback the right way. So what is this guy doing over here? Like, he's got more money than he knows what to do with this all of a sudden. But honestly, guys, you can't be lazy with your money, or your money's going to turn on you. You got to do the work, and you got to understand where you're placing it, and you have to understand a buying criteria, and you have to be able to underwrite to a certain degree to, trust but verify these operators. So I think what happened in our space specifically is that there was this euphoria where we got to compete, we got to buy it all. They're never going to stop printing money. They can't lower or they can't raise rates. Okay, this was the sentiment. We all heard it. Okay, and then all of a sudden, oh shit, the rug got pulled out, and all these assumptions and all this risk that we're putting out there came home to roost, and that's what people are dealing with right now.
Jake and Aleksey, if I can speak from personal experience, in 2005, my very first investment with a partner was actually a syndication. I didn't even know it was a syndication, and I decided to invest. I always call the gentleman Maserati Mike because he drives into my parking lot at the restaurant driving a nice gold Maserati, and he says, Gino, let's partner up. And I fell into the passive investor trap of I've got money, he's got experience, I'm going to give him my money, and the person with the experience takes the person's money away. And that's what ended up happening to me. And for a couple of years, I was truly bitter at the situation. But when I look back at it, what Jake said was I had the responsibility to understand the investment vehicle. I had the ability and the understanding of how to underwrite that deal. Did Gino get on a plane and actually go down and take a look at the property? Did Gino actually vet the sponsor and maybe do a criminal or credit background check? Did Gino look at his other properties? I did none of that. So I can sit here and blame the operator all I want. And it was his fault because he is a dirtbag to this day. But at the end of the day, it's all about my responsibility. And if I had not invested with him, he wouldn't have done that deal. You know what I'm saying? So I think right now, I want to really steer this conversation as to what can the Ginos of the world who are starting out and want to become passive investors, because there is a true way to do it the right way to grow your portfolio passively. Because if you're a doctor out there and you're working 80 hours a week and you want to participate in one of the best vehicles to create wealth in this country, but you don't have the time, because you're working crazy hours, you've got to focus on your profession. How do you do that, Aleksey? Let's talk about from the passive investor side. What do limited partners need to do to become truly, really good real estate investors?
Yeah, so I'm taking a few notes. So first of all, I think, Jake, one thing you said was trust but verify. From the perspective of an LP, I would actually flip those. I think you should verify and only then trust. And at some point, there's a question of when that point is. For example, is that when you get your first distribution check? Or perhaps it's when you actually exit from a deal? Do you start actually trusting a person? I tend to
I wouldn't
believe
trust
that
him on one
trust.
check. One check is not going to be enough. That sounds like the beginnings of a Madoff situation, right?
Well, so Jake, I mean, you'd be surprised. Like, I can tell you that I advise a bunch of LPs now that invested in 5 or 10 deals with the same sponsor. All of them went bad. But when you start asking them, like, tell me about the story goes something like this. Like, I met someone and they were super nice and trustworthy and candid, and like I invested, and the check came in, and then the month later there was another email about a new deal, and it looked interesting, so I invested in that one, and then another check came in, and then I invested in another one. And so obviously I'm not talking about percentage of net worth. In some cases, by the way, for what it's worth, these percentage of net worth are, I mean, incredibly unhealthy. Um, and that's perhaps its own hour of a conversation. But
So I just want to be clear. I just want to be clear in what you're saying. The amount of capital that these LPs are putting at risk is too large of a percentage of their net worth to be placing in these deals. Is that what you're stating?
that's exactly what I'm saying. Yeah, yeah. I mean, um, and I'm not here to tell you what the percentage should be, right? But I think people, and Jake, I think you alluded to this yourself, right? Like there's this euphoria of like real estate is super safe. I can't lose money. Prices of real estate go up, rents only go up. I
Well,
can
guys were
2x.
competing though too, right? GPs were
Yeah,
competing and flexing on one another, and
yeah,
they were
yeah.
pushing each other up and up for the deals and the money, right?
Absolutely. Yeah. And so and sometimes you would push out an offering and within 24 hours you're fully subscribed. And then the LP that reached out on the 25th hour is like, what the heck? I missed out. I better, commit faster next time. I don't need to do diligence. I just need to put my money in. Otherwise, I'm going to miss out. And so that's the really hard part about investing, I think, is in those times you really need to be patient. And the hard time, back in 2021, 2020, like What was your savings account making you? 0.5%, right? Um, right now you can sit on, close to 5%, almost risk free, which is another situation. But back then, like people were just, the money was burning a hole in their pocket, so to speak. Um,
Let's plant the flag for anybody that's listening right now. I think this is very important. Times change, market cycles can move quickly. If you ever end up in a situation again where you're missing out on deals because it's a speed thing, okay, guys are putting in offers quicker than you, deals are getting done at a rapid pace. That is short lived. That is not normal, okay? And be okay missing out. Because
yeah,
if you push too hard to get in, you're joining this exuberance, this euphoria. That's when you're going to get burned. That is a tried and true, clear message. The world listening to yourself. Don't feel like you got to compete on speed, whether it's for the deal, right? Because 20 people are lined up with the broker's office putting offers in that only work on bridge debt. Okay, don't get caught up in that. And the same thing from the LP side. If you missed out on an investment that there's a million more of them, coming around the corner, that's okay. Be patient. Don't force money like this, or it's probably not going to come back to you, right? The boomerang is going to go one way and not come back.
Jake's telling you what to do. I'm going to tell you how to do that. You want to hear
I'm
how to
sorry.
do
I'm
that?
not telling you what to do. Take that back. I will never tell anyone what to do. In my opinion, I think that's something
But
you should not do. All right,
okay,
because I'm not
but
giving investment advice here.
what,
Right?
what you're trying to do is
Aleksey, he's my attorney. He advised against that.
what I'm trying to allude to is you're trying to create a framework of what you would do. Now, how do you
There
do
you go.
that? That comes down
Thank you, Gino.
that comes down to the psychology of money. Read the book by Morgan Housel. Understand the relationship that you have with money. If money is burning a hole in your pocket, what does that say about yourself? That says that you need instant gratification. You need to jump on the next deal. Pull back and ask yourself, why do you need to do that? The whole meme, cash is trash, was the stupidest thing I ever heard of back 3, 4, 5 years ago. Now cash is gold. It still bothers the crap out of me because that's such low level clickbaity crap. So it really gets people's dopamine going. Really understand why you're doing this and what your investment, I guess, philosophy is. You need to understand what your relationship with money is and what vehicle really fits your relationship. For some people, real estate may be too slow and too boring. You're in a deal and where's my money? Where's my money? I want to get into the next deal. It may not fit your persona or what you're trying to accomplish. So read the book by Morgan Housel and understand what that relationship with money is and see if whatever vehicle you're out there trying to invest in fits your persona. And then don't get caught up in the hype. Don't get caught up in the fear of missing out because the market cycles are long and they change. And deals come back. And that's why one of the best reasons why we like to create wealth with real estate, it is slow. It's not difficult, but it does take a little bit of discipline and it does take an understanding. There's certain rules in how to create wealth. And I think real estate really lends itself to that. I don't know if you want to add anything to that, Aleksey.
yeah, I think that's you guys are making great points, and I think they're fair and balanced. One thing that you said earlier, Gino, was, if you're a doctor or an attorney and you don't have time, like, what should you do? And this is an unhinged, so to speak, take that many GPs don't like me saying. But I think if you don't have time, you shouldn't invest. You shouldn't touch these things. Like, if you don't have time to understand what you're investing in, just don't invest. Like, go put your money in an index fund and forget about it. Like, that's a real option. Go put your money in at 5%. And look, obviously treasuries might change.
I love
Next year might be
5% money.
4%,
I think it's
whatever.
sweet.
But like your investment options are always a function of your alternatives. And I'll tell you something, the alternatives right now are pretty good, right? Like, and even when they're bad, here's the other thing that I want to touch on quickly. Um, you know, people, Jake, you mentioned this, is people like YOLO their money. You only live once. You just got to put it in. Money is burning a hole in my pocket. And then I get a call. Like I advise LPs both on, new transactions, but also existing ones. So I hear what happens when something goes south. And in all of them, consistently, when something goes south, say the same exact thing. It's like, when I invested in this, I just didn't understand that I could lose my money. it didn't even occur to me. Like if you asked me, but by the way, this is still true to today.
What's the emotion that you go through when you hear that? Like what
Oh, I
goes through
mean,
your body when you hear an
it's like a
LP say
therapy
that?
session. I mean, like I'm like a part-time therapist. Like you have no idea how it's like to speak to someone that lost the majority of their retirement and they're like 80. Like I speak to those people almost weekly. Um, and they invested like 70% of their retirement and they're crying on the phone saying like, I don't know what I'm gonna do. Like I'm pretty sure all of these properties are about to foreclose. There's a capital call and I don't even have the money to put it in. So now I'm gonna get put behind someone else. And even if I invested, I probably might not see my money back. It's just those times are like, and many GPs, by the way, like they have a hard time with me sharing those stories. Um, but slowly I've like realized that I need to put my foot down because I here's the deal. Like if you're an LP and you hear one of these stories about someone lost money, you have one of two reactions. Either the reaction is, oh, yeah, obviously you can lose money. Like let me learn from this person's mistakes so I don't make those mistakes. So to me that's valuable. The other response that happens all the time is, holy crap, like you can lose money in syndications. This is not for me. Like I'm not ready for this. I don't know how to do this. I just don't want to do it anymore. And they close their laptop and go invest in an index fund. To me, and this is already controversial, but to me, that's a successful outcome. Because if you don't understand what you're doing, you shouldn't be investing. Of course, from the GP perspective, they're like, well, that's um, that's capital that just sort of like flowed out of the system because of you. And what I say to that,
No deal is better than a bad deal.
yeah, I don't think it should have been in the system, right? It was money that was misled, so to speak. And I think the last thing, sorry, I know I'm rambling on, but both of you guys, I think it's clear to people that losing money hurts, but I don't think people understand how much it hurts. So just to illustrate, um, for example, you invested 100 grand, right? And let's say you only got half of it back. Now, many people listening are like, "Ah, come on, like what are the chances of that?" I can tell you the chances happen. Like I speak to people every single week that not only get 50% back, but get nothing back, right? So it happens. I'm not saying it always happens. Obviously, there's a reason why this industry exists, and on average, people do okay. But if it happens to you and you get 50% of your money back, and then you invest that 50K at 8%, which is not risk free, right? But let's assume that you can assume, you could put it in at 8% and it every single year earns 8%. It takes you 9 years to get back to 100K. 9 years of consistent 8% return to get back to where you were. Not anything extra, just getting back to where you were. So I think the downside risk of these investments are just, going back to your point, Gino, like, what do you need to do? Like, the first thing is you really need to understand where the downside risk is. And if you don't, or you don't have time, I have clients like that all the time. They'll call me and they're like, I have $1 million, like it's just sitting around in a checking account. I don't know what to do with it. I need to invest it. Tell me where to put it. And my first answer is I'm not going to. I don't do that. Like I can educate you, I can explain to you what I mean if you have questions. If you're too busy with a surgery or whatever, good for you. Like invest it in an index fund.
So, Aleksey, this is why Jake and I created our passive investor program, because of all the experience that I had of that first deal losing capital. And for us, we don't syndicate deals anymore. We're just strictly out there having the Jake and Gino community. There, we don't raise any money from our students, but we want to create this healthy environment for limited partners. So to your point, we don't want limited partners bidding up deals and having general partners fund deals that don't make sense. It's hurting us and it's putting us out of the business. And we're trying to create a healthy community of limited partners to be able to understand how to buy right, how to manage right, how to finance right. We're two operators. We're in the business. So we're teaching it from the lens of the operator who's actually done over 2,000 units in the last 10 years. We vertically integrated. We manage our assets. So you're going to learn from two people who are actively doing the business. You want to learn it that way if you're going to become a passive investor. You want to learn it from that way and then learn how to, I don't want to say shortcut, but once you've learned the business itself, then you have to work on yourself, whether it's investor goals, what kind of markets you want to be in, what kind of asset classes you want to be in, what's the time frame of your deals. That's the beautiful thing about investing passively. You can do build to rents, you can do RV parks, you can do multifamily, you can do short terms, you can do Airbnbs. For you, if I'm looking to passively invest, what do I need to learn? I mean, what are a couple of the high level points that I really should focus on when I want to become a passive investor?
So that somewhat depends on the strategy, right? Um, However, I would actually say that it depends on the strategy less than, and by strategy I mean asset class. Like, are you investing in multifamily? Are you investing in industrial, whatever, single family homes? Um, but I would actually say that if you're investing as an LP, it actually matters. The asset class matters less than people might think. In other words, what people tend to do, and I wholeheartedly disagree with this, and I'm not so popular for it as a result, is people will say, I invest in multifamily. I really need to understand multifamily. Then what happens is they get a deck from a GP and they're like sitting there analyzing the property. And I'm like, hello, like, wake up. Like, it's not just about the property. And in fact, so I've authored what I call the three pillars of LP investing, and they're in order of importance. The number three pillar, i.e., the last one, is the property. And so some people are like, well, what comes first? What else could be more important? Location, location, location. And my answer is the first pillar is like, who the heck are you investing with? Do they have the experience to do this? Have they shown you a track record? Have you audited that track record? Have you run background checks? Are they trustworthy? And just because they have a bunch of, social media likes, or maybe they're your uncle, doesn't mean they're trustworthy, right? So
What
that's
about time in
the
the business
for
for
sure.
the
Yeah, that's part
GP
of the
that you're talking
yeah,
about?
yeah, that's
No,
part of the track
I
record. Yeah.
but how what do you my specific question is, how long do you recommend? One market cycle, two market cycles? What is the and I'm what I'm trying to do is drill down for anyone who is a potential limited partner right now so they can
Sure.
begin to create and mimic this framework if they so choose. What do you recommend? Is it one market cycle? Is it two? Is it 10 years, 20 years? What are you looking at?
Yeah. So let me tell you about the second pillar really fast, and then I'll swing back to this. It's related. So the second pillar is alignment of interests. In other words, how are GPs, how is the GP LP relationship defined, which includes the fees, the co-invest from the GP, and also the waterfall, right? What is the pref? What's the split between the GP LP profits, right? And so the reason why this comes back to your question, Jake, is, I mean, I'll just give you an example. Let's say you can invest in someone that has, um, it's their first deal. Like, they came to you and they're like, Jake, I have no freaking clue what I'm doing. It's my first deal. You invest all the money because I don't have any. But you get to keep 95% of the upside, and I'm not charging any fees. So, that's a
That's the
decision
bare
from
minimum
an
to even look at it. Yeah.
well, but that's my point though. So that this
Yeah.
is the thing that I think many people miss is like they make these like rules in their head of like, I want one market cycle, I want two market cycles, and that just like completely misses the whole point of investing. Investing is about risk and reward. So if I show you a deal with someone that has two market cycles in, but there's no pref and there's no co-invest and it's a 50-50 split, so from your perspective, you might actually invest in the guy that gave you 95% of the upside. But at least you're going into that knowing like, hey, this from an execution perspective, this deal is a lot more riskier than the guy who has done this for 20 years. But I understand that. I understand that the downside is probably higher, but I'm willing to take on that risk because the upside is much higher, right? So this is a thing that I think is super important. Like, um, I don't give people guidance on like it's okay if someone has a 1 year of experience or only one deal under their belt. It just shouldn't be. My point is always that deal shouldn't be looked at the same as a deal that has, a 50 property track record of exits. Like it's just different. And the
Mhm.
question from an LP perspective is always like, what compensates for that additional risk, right? And some
Mhm.
things you can compensate for, and some things you might not be able to. For example, in some cases, I see GPs that have like they've committed like SEC fraud 15 years ago, and so that's an LP decision. Like, can I trust this person? And they seem friendly and they're so nice. But that doesn't mean that you can trust them with your money. On the other hand, people change sometimes. So maybe you should. And that's a personal decision that you have to make. In other words,
But it all goes back to what you said of the sliding scale of risk, reward, and value, right? And I think the other thing here that you're looking at, so you're looking at experience, okay, and also the thing that has to come into this is skin in the game. So if someone has moderate experience, you probably want to see them participating, from a capital perspective themselves. That's going to feel better if they're putting skin in the game that has not anything to do with the fees that are being raised, right? So I think that's also a component of it where you can start to essentially create a criteria. And to his point, there may be a sliding scale if someone's a newbie and they want to give you all the upside, and then they learn on your dime kind of situation. That happens
right.
all the time. I think that's totally fair. I think I was under I think when I posed the question, I was assuming that you're looking at groups that have been in the space that are doing you know uh, pretty typical offerings, pretty typical splits. And I think in those scenarios, seeing at least a market cycle, seeing some skin in the game, feels better, from a level of risk, but it doesn't mean it's not there. It doesn't mean it doesn't exist. I think to that third point, which you said is the property, it's not only the property, folks. I think you got to understand. So it's the property, but also it's the management. Who's managing the deal? What is their track record, right? Because this group could be in 50 different states, and they're using third party, and all of a sudden they go up to New York, and either it's a landlord tenant issue, or it's a poor manager, and that can bite you in the ass. Or you could go to the finance piece of this, and they could be using bridge debt, and all of a sudden things are going to skyrocket, and you saw taxes go up, and you saw insurance go through the roof. So it's a not a simple answer. I think there's a lot of moving parts to it, and I think that's why if you are a extremely busy physician and you don't have time to vet this at all, you know you ask yourself and look in the mirror, is this right for you, right?
Right. So I guess two comments on what you said. Co-invests are interesting because what you're trying to accomplish with a co-invest is it has to be painful on the downside, right? That's really what you're trying to accomplish. Um, and painful on the downside is um, a relationship between the dollars invested and the person's net worth. In other words, if it's the guy's first deal and he has 50 grand in the bank account and he puts all of that in some ways I would argue that's better than a billionaire who puts in $1 million into your deal, which might be
There's going to
even
be
a
some
larger
scrappiness there
percentage.
fighting for it. Yeah.
That's what I'm saying. Like, I mean, they're just gonna like live and breathe this deal, and they might not know what they're doing, because as we said, like there's additional risk since it's their first deal, right? But like, the billionaire has like 50 other properties to collect the promote on, and in a sense, obviously there's a reputation, ethics, putting that aside, like just from a monetary perspective, relative numbers like really matter.
Impact.
Exactly. And then the second thing you said is like who's managing. I've seen that to be super important. Um, I think in some sense, I'm curious to hear your thoughts on this, but I found that vertical integration, in many cases, is overblown. In other words, it's like it's sold as this like, hey, we want to control what's happening, but behind the scenes, Um, and I mean, I've seen this inside as well. Like behind the scenes, there's no time to like actually train staff, and it's like you're really focused on acquisitions, and like it's just all over the place, right? So in my personal opinion, like um, until some threshold is met in terms of units, my opinion is it's actually much better to form a partnership with a property manager. Obviously, you should sit on their ass, so to speak, and like be on top of them, and you need a person that's doing that all the time. Um, but but the notion that we're gonna start and we're gonna acquire a first property and we're gonna manage it in house. I mean, to be candid, like I've seen that not work out many times.
Yeah, no, I'd love to speak on that because I think there's the devil's in the details when it comes to that. And the first point that you brought up is scale, and scale is real, right? If you're
Yep.
going to have Gino who just bought a property and you're going to invest with him and he's the property manager, he's running it. That's a different scenario, as you're alluding to, than a group that has scale.
Why are you picking on me? What did I do wrong?
Hang on. There's also the point that, well, do they have proper systems? Do they have proper training, and are they training their folks up? I think behind the scenes, and this is what I've heard of a lot of third parties, is that it's really disorganized and messy behind the scenes, actually at third party groups as well, and
I agree.
it's
Yeah,
uh, it's a fee chasing game a lot of times. So there's an issue with alignment of interest. To our previous point, I'm not saying it doesn't
totally
work.
agree.
Where
Totally agree.
and the point that I'm getting to is that the intersection of a beautiful business when it comes to the property management and when it really works is when you have scale, when you have someone that's treating it like a business. They're actually doing what you're saying, proper systems, proper training. But the true sweet spot is when they have vertical integration, not to just the property manager, the leasing agent, and the person doing maintenance, or how many ever maintenance techs. That's nice to have, right? But that's not going to get you the huge benefit that what we call vertical integration is. And that's when you actually bring on the CapEx teams that you can manage across the portfolio to lower costs. Okay. So control matters, right? And I think anyone that's done asset management has been on the calls where they've had a reluctant property manager who won't, try the rub scenario, or who won't attempt to take laundry and do this with it or whatever. So there's the resistance piece, and what happens is you have a 10 to 15% benefit in your fee game, right? Meaning that the
Mhm.
fee side of multifamily can bring you 10 to 15% additional revenue, and if you have a resistant property manager, it's going to affect that 10 to 15%. Where the true magic happens in the vertical integration is when you're able to incorporate the renovation teams in house, pay the salary component to that, and pay those folks directly, buy things at cost in bulk. That's when you see that huge uptick in profitability. That's where scale, the training, all of it comes together
Sure.
and makes
Yeah.
beautiful magic. And that's where I think people get lost in, well, we're vertically integrated. We have a property manager and a maintenance tech. That's not what we're talking about. We're talking about true vertical integration where everything is coming together, from like the marketing standpoint, the HR, all of it's working in harmony together to drive the quality of the home for the resident, which will in turn keep the person there longer because they're having a good place to stay, they're being cared for, the customer service is there, and you're bringing down costs through the team base in that geographical region. That, to be as specific as possible, is what I mean by making more money, providing better service, and really driving vertical integration that matters versus what can be a talking point and a shit show behind the scenes without training and people not knowing what they're doing. So sorry for the long-winded answer. I just I think you got to clarify
Yeah.
that sometimes.
No, I
Yeah.
think I agree with everything you said. Like, I think there's benefits to both, and I'll be, on record saying, property managers, external ones aren't perfect either. I think I agree it's a fee chasing game. They're not aligned. It's not like they're getting paid on NOI. Most times it's as a percentage of revenue. And so, yeah, look, it's not perfect. It's a game.
Yeah, no, just of some issues, in the last run up where some larger groups got caught up in the euphoria as well, and there was some illegal things happening and some theft and whatnot. And look, that's going to happen in any business, right? So I'm not, but as things get bubbled up and there's run ups and things, people start doing some silly things, and so that was one of the issues. Sorry for the delay there. Go ahead.
I think you alluded to these points already, but just to reiterate them, um, you have to choose between two. Uh, it's not evils. I don't know. Two imperfect solutions, right? One imperfect solution is deal with a third party, um, right? And they're not incentivized by NOI directly, and so. But the benefit is many of those folks have been there for a long time. There's training, there's expectations, there's like statistics that they sort of like are comped to in a sense internally. And the other imperfect solution is, you buy your first property and you're like, you know what, I'm just going to manage this thing myself. And you hire a property manager and you have no idea like what to tell them. You don't know how to answer very basic questions, right? So look, it's a two options. They're both good options. I think one is just better than the other. And my
I
larger
think you're
point
looking
is
for the term trade-offs, right? You said
trade-offs.
two
Yeah,
evils. I think
yeah,
what you meant is
yeah.
trade-offs, because either you can scale much quicker and have potentially less headaches managing people, which is usually the biggest challenge for entrepreneurs, or you can get in the weeds and grow slower and build from the ground up. I think those are the trade-offs that you're alluding to.
Yeah, but I think there are also trade-offs for the early uh, investors in those properties that are kind of the guinea pigs in a sense from a property management perspective. And I think what's lost on many people while we're on this topic is, if you look at the track records of, let's say, I bought something in 2019, sold it in 2021, 2022, um, there's a ton of properties um, in those track record tables that entered at an NOI and sold at the same exact NOI, even though there was like this big pitch of value add and we're such great operators and it's going to be amazing. And by the way, let's not forget that some of these were bought in areas that had like a 20 or a 50% run up in some cases in that area, but like they didn't do any of that and they had no idea what they were doing. But I don't know if it's luck or whatever it is, being at the right place at the right time, they sold it a better cap rate and they made it 2x and everyone is happy. And now they put on the track record, which again, um, I think that's well deserved because they bought the property. But that shouldn't be confused with operational excellence, is my point.
I agree. Let's take a quick time out to hear from our sponsor.
Now, we have had a great run in multifamily, going from 0 units to over 250 million in assets. That's over 2,000 apartment deals that we've been able to purchase through our framework, buy right, manage right, and finance right.
Now, Jake and I, we created the Jake and Gino community back in 2015. We launched our first book, Build Our Profits. And since then, our students have closed over 60,000 units. That's over $4 billion in assets they've been able to close over the last 6 years.
And that's why this community has been so successful. We call it results-based education, and we pour back into the community everything that we've learned on our journey from 0 to 2,000 units and all our systems and scale that we use on our very own property management and investing companies.
Jake, I love that. It's not just education, it's implementation. So what I want you to do, click on that link down below, apply to work with our team, see how we can help you on your journey in multifamily.
All right, we are back. We've done enough hating for the day and what bad looks like. So let's flip the coin here and talk about the good and have a positive attitude. Who should be an LP investor? Describe that avatar in your opinion.
I think it makes sense to do LP investing once you reach like a certain amount of net worth. Um, I directionally, I think you need to be very comfortable with like having an investment being illiquid for at least 5 years, if not longer, right? You need to be comfortable with losing the amount that you are putting up. Hypothetically, like if you lost it, it wouldn't materially impact you. And I think what these investments are really good for is a combination of tax benefits, assuming you have active income, or I'm sorry, passive income to offset. with those depreciation benefits. And just I think they're really fun, right? Meaning there's a lot of alternatives such as like public REITs, for example, and I have like articles on this stuff for those that are interested. But you, if you want real estate exposure, you can get in the public markets, and that real estate exposure is actually, I would argue, more diversified than actually. I mean, I hope people would agree with me than just putting your eggs in one basket into one syndication. But I think the difference is, and this is where like the curiosity comes in, and like you're interested in a given market or a given property, and you're curious, and you have time to like actually ask the right questions. So you see a deck, and it's like I don't know if the right word is a game, but it's like it's just fun for you. Like it's educational. Like you look at this thing and you're like unraveling an investment, and you're like, okay, what do I need to know about this area? What do I need to know about this property? What am I missing? What questions should I ask? And as far as being able to access um, a specific area, right, or a specific property, this is the only way to do it. You can't do that in the public markets, right? Like you can invest in a REIT, but they're going to invest in a bunch of stuff. You'll never be able to speak to the CEO, right? So there's pros and cons, and I think there's a world where people can really benefit from these.
It's the bridge. It's the bridge for people who see people being successful in real estate. They like it. They want to be involved, but maybe time constraint. And so it provides an alternative for someone that, you know, maybe wants to be directly involved in a real estate investment, but either is time constrained or realize they don't really want to do the behind the scenes people management stuff. So I think it provides a bridge and access, you know, to these types of deals. Any books or recommendations, anything you've read in the last year or 2 years that added value to your life that you want to share with the folks?
Um,
Come on, you got a quadruple degree there. If you stopped reading, we're going to be extremely disappointed in you here.
I think so. In terms of the things that I find useful, I'm a big fan of the Founders Podcast. Maybe some business owners would appreciate it. David Senra runs that, and I find it very very inspiring. He like goes through all types of biographies, autobiographies, and summarizes them in a really nice way. And I think there's a lot of lessons to be learned there in terms of compounding over long periods of time, how to run a business, how to deal with challenges. It's a gold mine.
Best way for listeners to get a hold of you and pick up your newsletter?
Yeah, sure. So the newsletter comes out twice a week. They can find it at lplessons.co. That's co. lplessons.co. People can reach out to me at any time at Aleksey, Aleksey at hey.com. And in terms of finding me, I post pretty regularly on LinkedIn and Twitter. You can Google me. My name is pretty unique, and you'll
It's
find
X.
me on both LinkedIn. X and LinkedIn.
Before we get to Gino's wrap up, he may still have some PTSD from Maserati Mike. Would you accept him for a session on your couch?
Therapy session. I actually have a couch in the other room, so why not?
Gino, you're up.
Well, Jake is lucky that he didn't have to go through that. I went through that for him, so he's very fortunate. Life before Jake, life after Jake. Aleksey comes to the country when he's 11 years old. The American dream is to go to college and get as many degrees as possible and try to make as much money from those degrees. Finance, math, economics, accounting. He's got it all, baby. But when he goes into the real world, he's like, I thought I was going to make more money with more degrees, and that ain't the case. Started working for a fund, and then he starts, working with passive investors in his 3-step framework, that 3 pillars of sponsor, alignment of interests, and the asset class, in that order. If you're serious about becoming a passive investor and understanding how to invest in one of the best vehicles to create wealth, I would pick up the phone. Well, at this point, I would actually go on LinkedIn, because Aleksey is really, really on LinkedIn. I've seen a lot of his stuff. Start subscribing to the newsletter. Start tipping your dough in the water, and reach out to Aleksey.
Gang, as always, we believe in buying deals for the long term. Think in decades. I'm Jake. He's the G Daddy. We make it happen. We'll see you next time. Thanks.
Thanks, Jake.